$1.32 trillion of net premiums are received in the US insurance industry. The US insurance industry is a very, very big industry that's extremely resilient over time because insurance brings a lot of benefits and is essential to almost any individual or business out there. That's why there's over $1.3 trillion in net premiums received in 1 year. So let's go over some key terms first. So these terms you may hear a lot when you're talking about insurance. So the insurer or the underwriter is the entity that provides the insurance. So that can be an insurance company. The insured, so the policyholder, is the one that buys that insurance from that insurer. Policy is a contract that states which risks are covered and how much will be paid. So it basically tells you what type of insurance you bought and why, what money do you get, why. Coverage is the total amount of risk covered, and the premium is the amount of money that the insurer charges to the policyholder for the coverage. So in return for coverage, the insured has to pay the insurer a certain amount of money. So insurance. So insurance is the type of mean of protection from financial loss. So it basically spreads out your risk, and it's a type of risk management that can hedge your risk against an uncertain loss. So something that's unexpected. So how does insurance work? So in insurance, first of all, a person, so the insured, so the policyholder, they buy an insurance policy from an insurance company. So this person can pay the insurance company a premium. So it's usually a relatively small amount compared to the risk covered. And the insurance company gives a promise to give money to the insured in event of a covered loss as stated in the policy. So this loss can be almost anything, any risk, because companies have insurance for almost everything. So for example, the most typical ones would be car insurance. If you crash your car and each year you pay your $2,000-3,000 in insurance, each year in insurance, then let's say you crash your car and there's something that happens to you, they will cover your costs and maybe give you compensation for that. So there's a lot of types of insurance. So then burning down your house insurance, health insurance. Also, Taco Bell bought a policy for their tacos in 2001 for taco insurance to make sure they don't lose that much money with their tacos. So you can tell how there's so many types of insurance.
So why is it important to have insurance? It's important because of a risk. Chance of loss from an event that cannot be entirely controlled by emergency savings, which is a person's savings that can cover some unexpected costs. However, this is most likely not enough. For example, if your house burns down, can you take out $1 million to rebuild it immediately? Probably not. And so insurance transfers the risk from an individual to insurance company by paying a minimal premium. Next. Okay, you can go. You can go.
Here's an illustration of how insurance companies operate. So suppose there are 100 people in a group. There's a 1% chance that one of them will become sick and need $10,000 for medicine. So that's 1 out of the 100 people. So who knows? Who will become sick? Will it be me? This is a risk that no one knows and cannot predict. So if everyone pays the insurance company a total of $100 as the premium, the company will have $10,000 to cover the expenses of the one that gets sick. So everyone gives up $100, even if they're sick or not, but then that's the maximum they can lose. So it basically you caps your risk at $100. The 99 other people don't collect anything, but then they gain a peace of mind that they don't need to pay $10,000 and the max is 100 and protect themselves from a big loss. Usually this amount is way more, such as there's a lot of insurance, such as your car insurance. It includes liability insurance up to millions of dollars. So the coverage is quite a lot, but it's the spread out over a lot of people. So your premiums are very, very low. So insurance shifts risks from individuals to insurance companies. Jason.
So some benefits of insurance. Benefits include payments received from an insurance can far exceed the premium paid. So a home insurance policy that costs $2,000 can probably pay out almost $1 million if your house burns down. And it also provides financial security and peace of mind. Next. Some disadvantages of insurance include long delays to receive compensation, as insurance companies need to investigate sometimes. Insurance fraud is a really big part of this. Sometimes people fake their deaths to get fake life insurance. Companies may try to intentionally compensate less, and premium might be very high and not worth the risk. So the amount you're paying is not worth the amount you get if that risk were to occur.
So some common types of insurance are such as life insurance. So you receive your estate, so your beneficiaries after your death, they can receive a payment. This can range from hundreds of thousands of dollars to millions. Automobile insurance can protect your car and your liability for injuries caused. So that's very, very typical. Property insurance protects your house and the belongings inside. Health insurance pays for your health related issues such as medical bills. And also disability insurance is if you become disabled, you can receive payments because you lose the ability to work. So there's different sources of insurance where you can get insurance. So individual insurance, you can buy for yourself, for your car, for your house from your insurance broker. So you can get it from your employer as well, because as a full-time employee, your company may provide you with some health insurance according to the law. And the government actually provides quite a few insurance programs for all of us, including employment insurance. So if you get unemployed, get laid off, get fired, you can receive payments from the government, which is actually a type of insurance as well, because in every paycheck, you're paying a small amount of money to the government to cover this employment insurance as the premium.
So the process of insurance, an event occurs resulting in a loss. The policyholder makes a claim to the insurance company. Insurance company determines if the event is covered by policy, and if so, requires the policyholder to pay a deductible. And if the remaining amount is paid out to the policyholder. Next. What is a deductible and why? A deductible is a specified amount of money that the insured must pay before an insurance company will pay a claim. This places a loss on the insured, which will reduce the problem of moral hazard. For example, leaving your car unlocked on purpose, so your car gets stolen and you receive a big payment. Dollars paid from an insurance policy are not intended to make a person better off than before the loss happened.
So let's talk about one of the largest insurance claims in history, 9/11. So 9/11 in 2001, terrorists attacked the Twin Towers in New York by crashing two planes, killing almost 3,000 people. The company's insurance individuals were insured by a bunch of types of insurance. So like property, life, health, liability, and aviation liability insurance. The total amount of claims paid by this insurance company, both to companies and individuals, totaled $40 billion for only this tragic event, which really hurt the insurance industry at that time, as this unexpected event was very, very serious. A quick summary. Let's watch a video now.
Insurance. Wow, that was probably one of my more exciting words to start this video with. So we're going to talk about insurance today, and I promise I'm going to do my best to make this really interesting. Maybe, but if you want to learn how insurance works, stay tuned because that's what we're talking about. But back to the video. Insurance. It's the annoying necessity that we all pay for to make sure we don't end up in massive amounts of debt if our house burns down, if we crash our car, or if something tragic happens. Insurance helps us maintain peace of mind, knowing that even if something bad does happen, someone else is going to pay for what it costs to fix it. Though, to an untrained eye, this can be a little perplexing. I mean, if you pay $200 a month for home insurance, and after only 6 months your home burns down, the insurance company will buy you a new house, likely in the matter of hundreds of thousands of dollars. But you would have only given them $1,200. Why would they do that? That's the power of insurance, baby. The basic concept of insurance is that a company, The insurer offers a guarantee for a certain risk that may or may not occur. Then another party, the insured, pays the insurer in exchange for protection against that risk. When a bunch of people do the same thing for the same risk, eventually the insurer is getting a lot of income, but the probability of that risk happening is spread out among a bunch of people and stays about the same. Insurance companies make money by figuring out how much money they need to bring in to turn a profit on a given risk with a given probability. That calculation then influences how much each of the insured pays each month. In general, it's simple math, but in actuality, insurance companies have highly complex models for all of this. Not every insurance company offers the same insurance. Most insurance companies will specialize in their own kind of insurance. This is because each company has to develop a complex model to ensure that they can make money insuring a profit. If you estimated that 1 in 100 houses burned down each year, but it was actually 5 in 100, then you'd be losing money pretty fast if you insured those houses. You'd probably charge too little for everyone's insurance and then end up on the hook for those 4 extra houses. There are many types of insurance companies, from auto to health to life to homeowners. Most people in the world have these core insurance policies, some of which are legally required to be held, like auto insurance. You might be wondering though, why wouldn't you just want to save your money each month, get to hold on to it in a bank account, then if nothing bad ever happens, you have a lot more money? Well, while that may be true, it makes you the one exposed to the risk. If you put away $200 a month for a year to save on home insurance, you'll have an extra $2,400 at the end of the year. However, if your house burns down the next year, well then you're going to be out the few $100,000 that it's going to take to fix it. A pretty bad deal. Is that a risk you're willing to take? Chances are it isn't. That's why getting insurance is generally a good thing. It takes all of the risk and anxiety and financial burden off of you and puts it onto a much larger company that can afford it. When you understand insurance as just a way of paying a company to assume your risk, you can start understanding that insurance could, in theory, be offered on virtually anything. Are you worried that while you're toasting a cinnamon raisin bagel, your toaster will overheat one of the raisins, causing it to burst into a spontaneous plasma and destroy your entire pantry full of stockpiled bags of Lucky Charms and baked beans? Well, that's oddly specific, but someone could probably insure you for that exact thing. Likewise, maybe you're really attractive and worried that if you fall one time, you're going to hit your face, stop being attractive, and be depressed because no one will like you anymore. Well, somebody could probably insure you against that, too. This isn't too far off of reality either. Celebrities will often have parts of their body insured because their image is a source of their income. There's a few more pieces to the puzzle here, though, and we should talk about reinsurance and insurance claims. When an insurance company wants to buy insurance on their own insurance policies, well, then they buy something called reinsurance. That is not a joke. Say an insurance company realizes that they're overexposed to home fire insurance and a hot summer is coming up. Well, they could take out reinsurance policies on their insurance policies to protect them from high losses in case all their houses they insure just burst into flames because global warming and whatnot. Then all the risk is all on the reinsurance agency. This is a necessary thing, too. Think if an insurance company insured everyone in Florida's cars, but then a hurricane came through and destroyed all the cars. Well, that insurance company may owe more in payouts than they have, and once they run out of money, well, then no one would get money for their destroyed car like they thought they would. Reinsurance is necessary and important to ensure that insurance companies remain profitable and solvent to pay insured when there are claims. In terms of claims, insurance companies also don't just automatically pay out if you have car insurance and you show them a crashed car. The insurance company will investigate to make sure that you didn't intentionally crash your car to get the payout. If they find out that you did do that, well, that's called fraud and you can go to jail. Faking insurance claims actually does happen quite frequently. People see it as a way to either get a big cash windfall if they're in hard times, or get out of a car or house payment that they can't afford. However, car insurance agencies employ top-of-the-line investigators to make sure that they don't make faulty payouts. So now you can likely see insurance is a big business, and if you have the right models, assume the right kinds of risk, and have good investigators to make sure that you're not defrauded, well then you can make a lot of money. Conversely, if you buy insurance and something bad happens, it can save you a lot of money. In most cases, insurance is a winning formula for all parties involved. It helps consumers be less worried about bad events, and it makes companies a lot of money. And that's basically how insurance works. See, I told you it was going to be interesting. Maybe. Hopefully that was interesting. Otherwise, I don't know why you're still here. But we have more videos that you could probably click on right here that might be interesting. Or there's probably, if you're just tired of hearing my voice, you could click over to the insurance.
We have some reflection questions for everyone. If you could answer them and send them to the chat. Yes. Insurance is a practice or arrangement by which a company or government agency provides a guarantee of compensation for a specified loss, damage, illness, or death in return for a payment of a premium. Yes, that is correct, Jason. Yes, Josh, having insurance is a way to take risk away from yourself and give it to an insurance company. Number 3, life insurance, employee insurance. That is correct. Yes, to avoid paying amounts you can't afford. Yes, it maximizes your risk and how much. Number 3, insurance, Apple Pay. Okay, I don't think that's correct. Sean, yep. Cushion that helps people cover financial costs after a disastrous accident. Yep, that is correct. To protect against costs and mitigate risks. Yep, that's correct. Number 3, insurance, employment insurance and health insurance. Yep. And to prevent fraud. Yes, because it gives a loss as well. Yes, Cadence, you are to ensure that you are able to pay for potential losses you may face. Yes, it maximizes your risk. Auto insurance. Yes, that is correct. Okay, thank you everyone for coming to today's seminar. Thank you. Thank you so much, Sean.
Hello?
Hello. Hello.